Hi guys, this is Aditya Vora here. Hope you are doing well. The narrative these days has shifted from market kya lagta hai to Adani ka kya hoga. Looking at the price movements of stocks like Adani Enterprise, it becomes impossible for anyone to make money in it. On a lighter note, last week someone asked me how to play the Adani stocks. I told him, you don't trade Adani, it is Adani who trades you. I mean, isn't that true looking at the volatility in stocks? It has become a news based stock, to be honest. If you think and try to analyze what is happening in the Adani Group stocks, it is purely greed and fear which is playing out. Based on news, people's views on the Adani Group are moving like a pendulum. So, friends, using this analogy, I thought why not extrapolate this greed and fear concept and figure out where we are in the stock markets. After all, everything in life is about greed and fear. Now, before I jump into where the markets are and the outlook for 2023, let me briefly tell you a story which talks about why it is easier to sell fear in the world. There was this very famous author by the name of R.L. Stein. Now, his genre was primarily scary kids' books under the series Goosebumps. It sold almost 40 crore copies worldwide. However, very few people knew that before switching to the genre of children's horror fiction, he spent the first 2 decades of his career writing jokes for kids. Now, the question is, why did he switch after 2 decades? Well, in his opinion, scaring people was easier than making them laugh. The observation was that everyone had a different sense of humor. Some people like dark comedy while some preferred clean comedy. Comedy is a very subjective concept. The point is, while everyone has a different sense of humor, we all have the same fears. Hence, it is much easier to target something which is very common like greed and fear rather than humor or any other genre which is subjective and may vary from person to person. If you extrapolate this to the stock markets, don't we have to deal with the tale of greed and fear all the time? The point is, how do we benefit from greed and fear? After all, we are in the business of making money. It is our job to make the most of market emotions. So, how do we do that? Well, the answer is simple. I want to go one step further and highlight 2 things here. One, both greed and fear in the stock market are always overdone. And two, making money out of greed and fear involves timing the market. A lot of people talk about buy and hold forever. Well, in my opinion, buy and hold forever seldom works. In fact, timing the market is equally important as time in the market. Even non-cyclical sectors like FMCG, which are considered to be safe, the concept of buy and hold forever also fails. Let me give you an example. Now consider Hindustan Unilever, HUL. I am sure the initial thoughts which come to your mind will be safe stocks or quality company or stable return. Let me share some interesting facts about HUL. From 2002 to 2010, HUL stock price went nowhere. The stock went into an 8-year coma. The returns after dividends could barely even make up for inflation. The reason why HUL didn't perform was the greed factor at play during the period. Allow me to explain. The period of 2002 to 2008 was a golden period for the economy with massive tailwinds for the capital goods sector. Every sector linked to infrastructure and capital goods was booming. In fact, the real estate sector was on a roll. During such times, it is pertinent to focus on the sectors in flavor, which were the economy related stocks and not safe stocks like FMCG. Had you instead invested in the BSE Capital Goods Index in 2002 rather than HUL, you would have made a return of over 3,000%, a whooping 83% CAGR over the next 6 years. While this was one side of the story, which was dominated by greed, the other side favors fear. I'm sure all of you know that post 2008 financial crisis, fear was at peak. Hence, the FMCG sector became the darling of the market. Basically, it was a shift from risk on to risk off. The BSE FMCG index gave a steady 15% CAGR over 2012 to 2018 period, while the capital goods sector had stalled. Basically, risk off is a play on fear. It results in money going to sectors like FMCG from capital goods and infrastructure. I started this video with two basic ingredients required to make money in the stock markets: greed and fear. Timing them will help us make a lot of money. So let me answer the million-dollar question. Where are we now in the pendulum of greed and fear? In my humble opinion, 2023 is likely to be more of a fear rather than greed. 3 months into 2023, the benchmark index, that is Nifty, is down to 17,400 levels. The feeling amongst mid-cap and small-cap investor is already that of Nifty at 16,000 levels. Imagine if Nifty fell to 16,000 levels. A mere 7 to 8% correction is required for that. Now, this depends on factors like the US Fed's interest rate decisions. The point I'm trying to make is not how long the US Fed can keep raising interest rates. I am sure the end of rate hike is near. The question is how long will it let those interest rates stay high before it starts cutting rates? With sticky inflation in the US and even in India, interest rates are expected to stay higher. At such times, equity valuation takes a knock as money moves to and stays in bonds and fixed deposits. So the question is, what should investors do in 2023? Well, two things in my view. One is that I personally believe that exposure should be reduced from high beta stocks and move to safe sectors like IT. Now you must be wondering, with US recession, why would I prefer the IT sector? Well, it is said that during a downturn and high interest rates, the hiding places in the stock markets are limited. However, with high interest rates, the Indian rupee is expected to fall against the dollar, which will benefit IT stocks. Now, most IT stocks have fallen by 30 to 40% from their peaks in 2022 and offer a good risk-reward ratio on the valuations front. The recession impact in the US is mostly priced in the Indian IT stocks. Now, second thing is that there is a trend which we were seeing in the markets from the end of 2022 and is likely to continue going forward. The darlings of 2020 and 21 are getting hammered. Take the example of diagnostic stocks or take the example of chemical companies. While these are just two examples, there is a pattern and similarity of the type of stocks which have been hammered down and are still expensive. It's the high PE stocks. Diagnostic stocks, chemical stocks, and new age IPO stocks like Zomato, Nykaa, and Paytm types all have got hammered. Tell me one thing, how on earth can B2B chemical companies trade at FMCG valuations, or how can companies testing your blood have 100 times multiple? In 2023, as the pendulum oscillates to fear, these high valuation stocks, despite the fact that they have fallen by 50% from the top, will be further hammered as they have already been up by 5 times in less than 2 years. So net, while IT can be preferred, such high multiple stocks should be avoided at a time when interest rates are high. Also, with fixed deposit rates at 8%, equities are bound to become less attractive at least for some time going forward. 2023 may not be a great year for the market, but I personally believe you should still make the best use of the conditions before us. Look for good timing opportunities in select stocks on your watch list. Thank you friends for watching the video and do let me know for any feedback.